While steady deterioration in U.S. stocks has prompted growing calls from Wall Street that tariffs could tip the U.S. into a recession. Goldman Sachs on Sunday raising odds of a U.S. recession to 45%, the second time it boosted its forecast in a week. Joining us now, Julia Coronado, MacroPolicy Perspectives president and founder, and Steve Clemons, the Washington Note founding editor as well. Thank you both for being here. Julia, I want to start with you. Why are your odds of a recession only at 40% at this point?
They are not. We actually put on a recession call last week before the market meltdown on the tariffs that we calculate to bring a weighted average tariff on imports to 25%, which is even exceeding the Smoot-Hawley levels of 1930. So that's key factor number one, but it's an interaction of a lot of things, actually. The DOGE cuts not just to federal employment, but to government contracts across many sectors across the world, really injects a degree of uncertainty to the U.S. as a counterparty, to various sectors, companies, organizations, institutions making plans. We think that's going to put a chill on hiring. The negative wealth effect that we're going to see, and I agree, I don't think that this is over. And, you know, the draconian immigration policies, immigration has been a huge tailwind. So it's a multiple factors. These are all policy choices intended to be disruptive, but almost all of them are growth negative. So we do expect a recession to begin in the second half of this year.
And so, Steve, want to get your reaction to what's played out thus far, whether that be the market reaction or whether that be what comes next, because it seems like that's what everyone is trying to get ahead of right now. What retaliatory looks like as that's ingested over the coming days and weeks?
Well, listen, I've listened to a lot of your show this morning to various people that are blaming those captains of industry and finance who supported Donald Trump there, and they're now saying, oh my gosh, he may be having huge impacts. Listen, I don't think many of the people who supported President Trump knew that his team would do something as reckless as has happened now. And I didn't expect the president. I looked at how the president managed tariffs the first time around, and he had essentially what looked like a great label on tariffs, but he had a team that was highly sophisticated, that turned that tariff experience into a surgical one, that was very aware of things like market share and supply chain, and was able to kind of manage these issues. Peter Navarro, the president's advisor, has no interest in sophisticated approaches or surgical approaches. And they are wrecking. It's remarkable to the rest of the world that the president of the United States is wrecking his own economy, creating his own recession. It's like the king of the hill kicking down his own hill. And so, yes, a lot of people are extremely frustrated with the president and looking at what's going to happen. So, yes, there's going to be retaliatory rounds because they don't have a choice with their democracies in most cases, in many cases. And not in China's case, we'll put that on the table, but they're going to retaliate. They're going to protect their industry, and we're going to have a vicious cycle down as opposed to a reinforcing cycle up that's based on trust and confidence in the future. And I'll say something about President Trump right now. Political power is a lot like the stock market. Power is based on future expectations. Right now, future expectations of the U.S. market, and I would put Donald Trump in this, are just nosediving right now.
Julia, let me go back to you because investors are obviously concerned about that recession that you mentioned coming in the second half of this year. What are you telling clients who are freaking out in this moment about what they should be doing right now and how they should be thinking about the macro backdrop?
Well, the way we serve our clients is presenting the economic realities and forces that are shaping the economy. They're the ones that decide how to manage their assets. I will say, though, one of our notes of caution is that the Federal Reserve doesn't have the same ability to provide insurance the way it has in the past couple of cycles, even in the GFC. We are looking at an inflationary shock at a time when the Fed is still above its 2% target. We just heard from Chair Powell on Friday that, look, we see risks to both sides of our mandates. The ultimate responsibility of the Fed is to be the adult in the room. And right now, that means being patient and letting some of this play out. And if there's a stock market correction because earnings expectations were unrealistic in a world characterized by a trade war, then so be it. The Fed doesn't have the ability to just step in and catch the falling knife here because this is an inflationary policy. So that's a note of caution that we urge our clients to keep in mind, because every time the market corrects, there's rumors swirling that the Fed's going to come in and cut rates, and President Trump is calling on the Fed to come in and cut rates. And by the way, that may not be the antidote you think it is. If we are in a world where the U.S. is proving to be the most unreliable partner from a security perspective, from a trading perspective, we're seeing real questions and sort of nervousness around the dollar itself. So that could bring a second round of inflationary impulses. We're in an extraordinarily difficult and dangerous situation where there's not an easy policy solution when policy itself is the problem.
Julia, this question to you, and Steve, I'll allow you to answer as well. As we think about the business leaders that we were just talking about, perhaps getting caught off guard and perhaps it impacting to a greater extent than anticipated some of their own outlook about business, to what extent do you believe that flows through and impacts two of the measures that the Fed is tracking up against most notably, and one of the measures that they have the most control over in those business leaders, and that is employment? Do we see such a deterioration in employment that the Fed has to make an unexpected move or more moves than anticipated?
I mean, we do expect that the labor market will cool off in the coming months. Again, the U.S. economy is an ocean liner. It is the largest, most diversified economy on the planet. So tipping it over takes an extraordinary set of circumstances. So we just saw with the jobs report last week that, still looks okay. Now, there's a number of reasons that warm weather and the lack of the federal firings showing up, that it may have come in above expectations. But it's a good reminder that, look, the U.S. economy demonstrates resilience beyond expectations again and again. So right now, and this is, again, another reason for Fed caution, we do see resilience in hiring so far. But ultimately, that's going to be the proof of the pudding, because recessions are defined by job losses. And when and whether and to what extent we see companies really retrenching on hiring is going to be the test of the economy.
Yeah, Steve, wanted to let you comment on that.
Yeah, just real quick. What you see right now is anxiety dramatically increasing in the U.S. economy around firms and businesses. When anxiety increases, they basically freeze up. They become paralyzed. They're going to stop hiring. They're going to shed workers. And so maybe that does force the hand of the Fed to do something. But how remarkable is it that the Fed, looking not at underlying economic drivers, but looking at the White House in terms of what it's doing, that this was, this was an act that was avoidable. When you look at all of the steps the Fed has taken to give a soft landing, to avoid a recession, and in one fell swoop, everyone's revising their estimates right now to build in, just as Julia said, the likelihood of a recession because of the policies we're seeing. It's a remarkable moment in history. This will be a moment that we will remember for decades as being one of those moments that is very, very hard to explain in how much wealth destruction in the United States, and as Bill Ackman and others have said, the status of the United States was sort of kicked over the hill overnight.
I think the hope is that it is something that doesn't take decades to recover from as well here, especially considering the very folks that you mentioned who are tracking their accounts here today, tuning into Yahoo Finance and trying to figure out their next trade decisions as well. Julia and Steve, thanks so much for taking the time.